Hello, and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence. Welcome to the podcast, Eric.
Great to be here. Thanks for having me.
Glad to have you. Glad to have you. Let's start with, I guess, a fairly open-ended question. How would you describe the state of the ETF industry here? Are we still growing by leaps and bounds, maturing, losing out to other investment vehicles? I'm just kind of looking for that 36,000 foot up view right now.
Yeah, so ETF flows this year in the ballpark of 250 billion, which is a little light for them, but this year's been light for everybody. 2022 in general kind of scared investors a bit. It was a really rough year, as you know. ETFs still took in 400 billion though, which I would argue is a big feat. But going into this year, investors were a little timid. That's why they didn't invest in equities until about June, even though they were having a good year. And the other thing that happened this year is money market mutual funds now yield 5%. So that's kind of taken a little bit of the wind out of ETF sales temporarily, although some money goes into short-term cash ETFs. But generally speaking, ETFs are the place to be. They take in the most money, basically compared to other vehicle types, whether it's older stuff like mutual funds or newer competitors like direct indexing. ETFs to me are the vehicle of the 21st century and will be because they have, 6 to 10 advantages. They're like the MP3 to music versus CDs and albums, in my opinion. And so I dedicated my career to them, and each year I continue to be validated by the flows and the amount of issuers and asset managers who are now putting their best stuff in the ETF wrapper.
Got it. Got it. It's interesting. I know that you're co-host of the podcast Trillions with Joel Weber, and you had a show that, despite all the things you just pointed out about ETFs, that there's still the death of mutual funds is a little exaggerated there. I was wondering if you could talk about that. What are the trends you're seeing in competition between ETFs and mutual funds, and just asset bases in general?
Yeah, this is where things get a little weird because all the flows and a lot of the customers and investors are moving to ETFs. So you would think mutual funds would be almost depleted, but they still have 26 trillion if you include money market funds, but about 19 if it's equity and bond, right? So 19 trillion is still over double what ETFs have.
Yeah.
Now, here's the thing though. The markets have been so good over the last 10, 15 years, they're up like 250%, that mutual funds can see a ton of outflows, but their assets still go up because the stocks they hold have gone up so much. We call that the bull market subsidy.
Yep.
So when you look at investor interest, it's definitely going to the ETF. That said, mutual funds still have a ton of money, and a lot of the people who offer ETFs also have mutual funds. So they aren't going anywhere, and they also have DC plans where ETFs don't really penetrate. So there's still going to be the mutual fund around for a while, and there'll be some hits here and there. But largely speaking, I think all of the interest, momentum flows, and investors will move over to the ETF wrapper.
Well, let's talk a little bit about your book. In 2022, you wrote the book called The Bogle Effect. It focused on Vanguard Group, the founder Jack Bogle, and just the impact he had on a whole different slew of things, index investing, fund fees, and so on. What lessons, for anybody who may not have had a chance to read that book that's listening today, what are some of the lessons that you turned up in your reporting and your writing there that are applicable to today's investors?
Yeah, I think the big one, and Bogle had a life work, it's that cost matters. So when you're going into a fund or an ETF, really look at what you're paying because ultimately that's going to be taken out of your compounding returns, which is what we're all here for, right? Whether that's a brokerage fee to buy a stock or an expense ratio for a mutual fund. What he did is he basically lowered costs at Vanguard over 45 years to the point where you can almost get a whole portfolio for nothing. And then everybody else had to lower as a result. So we're kind of in this investor utopia because of him, where you can get almost anything international, US, small caps, bonds for, a mere 6, 7 basis points. So what we found has happened, we call it the Bogle Effect, is people have come down in the core of their portfolio, but then what they do is they go out and they look for hot sauce to add on top. And I think that's where, things like thematic investing, like Kathy Wood and ARK, or options, having a little options account, or buying a couple stocks, or even crypto, that has a place in the Vanguardian future, in my opinion. So I think what gets stuck is the middle. If you're an active manager that just makes a little bit of bets on, and you mostly own Amazon, Apple, and Microsoft, and you charge 80 to 100 basis points, that middle is probably going to go extinct.
Yeah.
But so in other words, cheap will have success, and shiny will have success. So I think that's part of the Bogle effect, is by making everything so cheap and easy, it ironically pushed active and other things to get a little crazier. so that it could be used as a complement on top of your otherwise dull portfolio. And so to me, that's a really big chunk of the book. So there's multiple ways that Bogle changed the landscape, and I basically try to cover every one of those. And obviously just give a few there, but there's quite a bit more. But he definitely had, I think, the biggest impact on investing of anyone over the last 50 years, besides maybe Warren Buffett.
Yeah, sure. Now let's talk about some of these spicier ETFs or some of these niche type products that are coming out there. And you've written a lot about, for example, this saga between the SEC and the crypto ETF spot Bitcoin process and so on. Where do things stand with that, and how do you see that shaking out in the rest of this year?
Yeah, we have a 75% chance that the SEC will relent and approve spot Bitcoin ETFs this year. In my heart, I think they should have approved them 6, 7 years ago. I think ETFs are wonderful and can really help actually bring regulation and transparency to the underlying market. So I think there's some legal things that have to be hammered out, but there's still a 25% chance they don't get approved. But let's assume they approve them, right? Because they just lost an important law case in court. And long story short, that they have very little wiggle room now
Yeah.
to like basically deny for the same reasons they were. So let's say they approve them. What we're likely to see come October, November, or maybe January next year is like 5 to 7 ETFs rolled out at once. Probably BlackRock, Fidelity, maybe Global X, ARK, something like that. And all of them will do the same thing. They'll hold spot Bitcoin ETF just like GLD holds gold.
Yeah.
And the reason this matters is because when it comes to commodity ETFs, everyone loves it physical. That's why Bitcoin futures ETFs doesn't have that much in assets. Gold futures ETFs don't even exist anymore. People would rather not use derivatives, have them store it. So when a spot comes out, we see it being maybe 20 billion in the first year, and then ultimately $100 billion category. As more issuers come in, they also could be a fee war. The Bogle Effect will happen. People will price each other down, and so you're going to have this situation where you can get crypto, Bitcoin, probably Ether, for say trading 1 basis point spread. That's the bid-ask spread will be 1 basis point, almost free, and the expense ratio we think will be between 20 and 50. And that's going to be a beautiful thing. That's going to definitely draw, especially the advisory world,
Yeah.
where they're a little more conservative than do-it-yourself investors. They'll be more enticed to invest in crypto if it's in an ETF wrapper. So to me, it's not just about a Bitcoin ETF. It's about a bridge from like the normal, especially boomer world, and like the crypto underground. That's what this is about.
Got it. Got it. Now, one of the other trends that I've seen, and I think you've talked about before, is this whole kind of single stock ETF trend. You get levered or unlevered exposure and short exposure. The Simplify, Volt. So these things are such a mouthful. The Simplify, Volt, Tesla, Revolution ETF, for instance. And I know Direxion's got a whole lineup of long
Yeah.
and short ones. What are your thoughts on that? Is this positive trend, negative trend? Is this something that kind of gets ETFs away from what the purpose was in the first part for them?
Yeah, it's a great question. And I think if you look at these products through like, oh, the core of your portfolio, they're all horrendous. You should never use them. But I don't judge, I don't know, ice cream or hot sauce versus my main dinner. I would judge ice cream flavors against ice cream flavors, like Ben and Jerry's versus Haagen-Dazs. That's what this is. You have to look at this as hot sauce. So, as I said earlier, if you have all the serious investor stuff covered in like aggregate bond ETF and a total market equity ETF, so you've got Apple, JP Morgan, Microsoft, and you got what you have it.
Yeah.
So what you're looking for is a little fun, a little speculation. In that bucket, these products are totally viable and legit. And I think that's where people get confused. I judge them for what they are.
Yeah.
I judge them as hot sauce. And I think the Tesla one is unique. What they're saying is Tesla, single stock Tesla ETFs have actually been a hit. The ones that go 1.5x long and short. Again, because it's easier to click one button and put on that leverage trade, or click one button and be short Tesla, than for a normal person to actually try to do those things on their own. So ETFs just make it convenient. This new Tesla fund is saying when Tesla's momentuming up, we'll actually leverage 2 times.
Mm-hmm.
And when it comes down, we'll actually eliminate our exposure to 25%. So in a way, it's sort of like, let's ride Tesla momentum and see if we can actually beat Tesla the stock, because we all know you want Tesla returns.
Yeah.
And most ETFs that have attached Tesla to the name have been successful, even the Tesla Yield ETF. So the marketplace is just responding to what the investors are demanding. If they did I don't know, let's give me a stock like Bank of America, nobody would buy this. But Tesla's just the kind of stock that people just love to gamble and speculate around. So naturally, any kind of like gadgets that involve Tesla have a good chance of success. And again, this is people who probably have a boring defined contribution plan and are looking to have a little fun and scratch that behavioral itch. I mean, yeah, with this kind of stuff, which I would add, if it keeps them from touching the boring vanilla while that compounds, because compounding returns is what we're all here for.
Yeah.
If that keeps them from touching that, God bless it. It's actually performed a behavioral hack because in the 80s and 90s, the problems with investors is they buy these active funds, they would do well for a while, and then when the active funds started underperforming, they pull out right when the active fund's about to go up again. So I think Bogle also did a good job of solving behavior because people were like, I'm not going to get a better deal than cheap beta index funds. I'll just do that. But they still crave a little excitement. So I think that's why you're going to see products like these where you might scratch your head, but if you think about the way I just explained it,
Yeah.
I think it will make more sense.
Yeah. Now, one other thing, you just rolled out a feature I think called ETF of the week, and just sort of some of the things you're seeing in the marketplace that might not be captured in the mainstream, and that was actually a small cap energy ETF. Is there anything else that's noteworthy that you're seeing out there, whether it's developments in products, performance, any other ETF trends that you think are particularly noteworthy here?
Yeah, we've seen, I mean, first of all, the ETF of the week, this is exactly the kind of stuff I'm going to go over at the Money Show. I used to do big trends like ETF to mutual fund and 4,000 foot analysis, as you call it. People, I found out, and I would just mention one ticker offhand. And the one ticker I mentioned offhand is what multiple people would come up and say, what was the ticker you mentioned? So I realized people at the Money Show are looking for tickers. They literally want actual funds they could possibly, invest in. So what I do is something close to ETF of the week. I go through about 20 ETFs that we're watching. Not to say they're going to go up or down, but we just find them interesting. They are ones we debate on the team. They're ones we look at. And I think PSCE is a great example. It's up 35% over the past 3 months, yet it still has a price to earnings ratio of 6. So that's interesting to find such deep value and such high momentum. And most people probably don't even know that ETF exists. So I think that's part of what we're trying to do. But in terms of ETFs that are kind of like, that we talk about and debate, I'd say, one that comes up is we've had some debates on the inverse Kramer ETF, that's for sure. Hasn't really gotten a lot of bites because it's long short. I think it should be long only or short only. But that's one that gets debated. The buffer ETFs we debate, that's one that determines your outcome. It says, like one of them says, you'll have no downside whatsoever. And will give you up to 16% of returns over the next 2 years of the equity market. That's been a huge debate because it uses options to do that.
Mm-hmm.
And what it does is it's a legit trade, but they charge you, I think it's 80 basis points for it to go out and do this trade, which is kind of painful. Some people think, well, you should just buy treasury bonds, which yield 5% a year. You get 10%. It's close to the 16, and you take no risk, whatever. But look, this is the kind of stuff we debate. I think buffer ETFs are one of those hot button issues. ESG is another thing we debate on the team a lot. I'm bearish. Other people on the team are a little more bullish. I think ESG, as I said earlier, if you have a cheap beta core, say the VOO, the S&P 500,
Yep.
is an ESG fund going to come along and say, hey, sell that and buy these stocks that we deem good without the stocks we deem bad? And then an investor could look at it and go, well, why do you think Tesla's bad? Why do you think Amazon is bad? I kind of want to own those names. So we don't think ESG is going to be able to replace the core. Where ESG may succeed is in thematic, like hot sauce, like a solar energy ETF or a clean energy, which just goes and gives money to stocks that are actually forging forward in the green environment, not penalizing bad actors like an Exxon, who many of us use all day and would be totally important in a green world. So I think ESG has too many complications. Others on my team are a little more bullish. But it's definitely taken a nosedive in the past year. But those are the kind of things we debate. Usually, when it comes to stuff like like a VOO, everybody on the team is like, yeah, it's a great fund. So there's some stuff that get unanimous. We love it, but there's some stuff that recurs as a debate pretty regularly.
Well, I was going to wrap things up by asking you if maybe give a sneak peek at what you're going to talk about at the Money Show in Orlando, where we're thrilled to have you. But you kind of already touched on that, so I don't know anything else you'd want to add on that point before we end this.
No, I would just reiterate that I will go through rapid fire 20 ETFs that we are looking at. Some may not be, some may be like BITO, could be the Bitcoin futures ETF, because we're watching it. Why? Because they're about to prove a spot, and BITO would start to lose interest because if you have spot, you won't need the futures.
Yep.
So this is a perfect example because we're watching BITO for this reason. I'm not saying Bitcoin's going to go up or down, but it helps you understand a trend that we're looking at and a story, and you get a ticker and you get introduced to a ticker and how it works. And I will do that over and over with multiple areas. Every time, sometimes there's new, like I said, gadget type ETFs that are like, wow, that's pretty cool.
Yeah.
And I'll say, and we'll introduce those. And then every now and then there's an old dog like VXUS, which is international. And something like that is definitely fascinating to us because international seems to have these nice 6 month runs. And then it just goes back in the doghouse as America takes back over, and again, VXUS has taken in all this money, but the US has just kind of come back this year. The Qs in particular, which are just a juggernaut, the Super 7 stocks have
Yep.
just annihilated international. I mean, international's still up, but the US has just gone and topped it. And so we might look at an ETF like VXUS to say, like, our investors still going into international despite the US taking back over. So again, that's not us saying it's more of us fascinated by something, and we're giving you a ticker that we're looking at to sort of determine this trend or the sentiment from investors. And so I took me a couple years at the Money Show, but I locked into that. I find that people really enjoy the tickers, going through them one by one and then giving some interesting backgrounds on trends. So that's what you can expect from me.
Okay, awesome. Hey, Eric, listen, thank you so much for your insights. I thank you, everybody, for watching here. If you do want to hear more from Eric, as we mentioned, he's going to be one of dozens of market and economic experts that are going to be speaking at the Money Show Traders Expo Orlando. We're scheduled for October 29th through the 31st at the Omni Orlando Resort at Champions Gate. If you like golf, if you like Florida weather at late October, if you like learning about the markets, this is the event for you.
Or if you like a hotel that has 3 swimming pools.
That as well. Hey, swimming weather in October in Florida, it still happens, so I like it. So again, Eric, thank you so much for your time, and anyone else, check the link in the video description below to find out more about the event. Take care.
Thank you.